The topic today is covered calls. You might have seen some videos on YouTube where people show their portfolios, a moderately sized portfolio, a couple of 100,000, but still generating monthly income somewhere of $10,000 a month, or very crazy figures like this. At times like that, it's important to remind ourselves that there's no such thing as a free lunch. What do I mean by this? Well, we're gonna get into it. I have some experience with options, obviously done the basic courses at business school, done a separate course with Nasdaq on options trading, and I've utilized options very selectively on a few occasions. The last time was during COVID, after looking at Toyota earnings and then modeling out a scenario with similar performance for Volvo and then utilizing options sparsely. Very small trade compared to the other ones that has been done in the portfolio, but it's a big risk with options. And we're gonna get into covered calls specifically today. It was something that I thought about using myself way before covered call ETFs became popular, became marketed by Wall Street. I saw it as a potential for extra income, just like they are marketed today. But what is the flip side of this? And how would my portfolio look today if I had used a similar strategy with, for example, Palantir and perhaps Porch Group, if there was more of a market for options in a stock like that? Let's get right into it. So the covered call strategy, is just you selling calls on a portfolio, the shares that you own. So I own roughly 1,000 shares in Palantir. A option usually has some leverage built into it, so every option usually represents 100 shares. So I could have technically sold 10 calls at Palantir and have these 1,000 shares cover those options. Could have been a covered call in that case. And let's model this back to those days when Palantir was trading close to $6-7 a share. I bought it at 11, something like this. In those initial times when Palantir shares dropped, nobody would have been able to exercise those calls that I would have sold. So I would have collected the options premium, nobody would have exercised the option, and in that initial phase then I would have gotten a better result in terms of total return, still negative return, because obviously Palantir shares was dropping in those early days, and the premium that I received from selling my options would have been the positive difference. But Palantir started to perform. Their growth rate recovered in terms of revenue growth, and the Rule of 40 just started to look more and more amazing. And stock price just started to rally, especially on earnings days. We saw a few days during the year when Palantir stock just jumped massively, 20-30% jumps. What would have happened in that scenario? Well, let's say that I would have had sold calls with the right to exercise, in this case at $13 a share, and earnings happen and Palantir, they jump to 28. Well, the person that I sold these calls to, they would have exercised. I would have been forced to sell all my 1,000 shares to that person for $13 a share, missing out on the difference between 28 and 13, multiplied by 1,000 in this case. And in that case, the options premium would not be even close to covering that missed upside. So stock would have rallied and I would have missed out on that massive rally if I had used a covered call strategy. So you're starting to understand where I'm going with this. The covered call works perfectly when the market is going sideways, when the market is going down. But on those few occasions where stocks rally massively, and these few occasions, they represent a majority of the gains. If you read some papers on it, you can see like the largest 13 trading days represent just a unprecedented amount of the total gains. And with the covered call strategy, you're gonna lose out on these massive rallies. And why own shares if you don't believe in the business, if you don't believe that the business will outperform and bring you wealth? So in my opinion, it's a bit of a false promise. And when you look at these covered calls ETFs, be aware of the survivor bias. I remember this from working at Söderberg & Partners back in the day. They used to rate funds, take a look at them, give them a red light, green light, or yellow light, like the traffic light, depending on where they saw performance going. And a lot of these funds that perform very, very bad, they tend to be cancelled, or they bake that fund into another fund with better performance. So it's a bit of a survivorship bias. Just a bunch of covered call ETFs, the best ones survive, they have this strong track record that they show based on when they wrote the calls. It's a lot of luck involved. And then as an investor, you read the prospect and you see, wow, such amazing return. But remember, for every amazing return, there is also a bunch of these ETFs that have failed, that have been cancelled, that have been baked into other ETFs in that case. So a bit of a survivorship bias in that case. And hopefully you're a bit more aware of the risk now with covered call, because this product is getting a lot of marketing, it's getting very, very popular, and I can understand that it's super tempting, especially if you see these videos on YouTube, people with moderate portfolios. Like I saw one guy with 1.7 million who was generating $58,000 in the month of October, and just breaking his record of 50,000 a few months before that. Obviously very, very nice returns on those months, but what happens when stocks rally? And over time, you're gonna be a part of the drops, and you're not gonna be a part of the recoveries. So the net asset value, the NAV of these funds, is just going to erode over time, even with the dividend reinvested calculated as a part of total returns. So in the long term, it's not a winning strategy, especially if we take into account how volatile the stock market is today. And I'm sure I'm gonna get some hate talking negatively about covered calls, but I think it needs to be said, especially in times like this when it's marketed so hard. And we need to remember that there's no such thing as a free lunch in investing. Alright, that's been it for this video, and as always, hope you guys make a ton of money, whatever investments you decide to make. Take care now, bye bye.